Hello and welcome to Portfolio Matters. Today we have Stuart Owen on, an old friend of mine, to share his worst trade in SQL Secured Lending. And can I just say how pleased Richard and I are to have another guest. And before we get into it, Richard will read the disclaimer.
Thank you, Keith, and welcome, Stuart. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. The views of any guests we may have on the show are entirely their own, may not be representative of the views of Portfolio Matters. A full disclaimer can be found at the end.
Great, thank you, Richard. Well, Stuart, take it away.
Well, thank you very much, Keith, Richard, for having me on your show. It's a strange one to be beginning with, my worst trade. Perhaps one day I can come back with my best trade, but perhaps better to start this way. So the trade I'm going to tell you about, not very appealing, of course, but I think it does sum up a quote that I've always stuck with me, which is that more money has been lost reaching for yield than at a point of a gun. My trade is very much along those lines. In thinking about what I did wrong, I've really come to the conclusion that at the heart of it is psychology, is about motivated reasoning. A friend of mine said that human beings were not rational creatures, we are rationalizing creatures. And I think that's what I was doing. I was inventing excuses for holding on to something that I really should have taken the hit on and moved on from. A third lesson will be do your homework. It sounds so basic, but I was trying to believe something in the general which wasn't true in the specific, and I need to focus on the specific. Most of my professional career, I was focused on equities, and this investment is involved, frankly, in debt and in loans. And it's really brought home the fact that when you lose in a debt investment, it's gone. With equities, to some extent, you've always got some option money. There's a chance of it recovering. With a debt investment, when you made a loss, that's it. Very difficult to come back from. Absolute classic lesson again. Sell your losers. It's one of the first things we learn. Let your winners run. Sell your losers. I did not do that. And the final lesson, I think, is quite an interesting one, in that we're always taught diversification is a good thing, but I was using diversification as an excuse for passivity. Right, so let's get into the detail of it. So the background to the investment I made is really to do with my investment philosophy. I'm trying to run my SIP as a pension fund would be run, trying to make an assessment top down at what prospective asset class returns are like, and then investing in those asset classes, typically via an ETF. So the investment was made back in 2014-15, and I was looking at various measures of prospective equity returns, looking at people like GMO Woolly or the CAPE ratios, this sort of thing. And I came to the conclusion that equities were richly priced. I needed to be elsewhere, but as we all know, fixed income and cash was yielding very, very little. So I was looking for what I called hidey holes. Where can I hang out, earn a modest return, and await for a better day? And the answer that I came up with at the time was asset-backed lending. This looked tremendous. One would be higher up the capital structure, backed by assets. So if things did go wrong, hopefully there was something to fall back on. And in the meantime, some income in my hand that I could reinvest elsewhere. So that was the background. And this is an example of the sort of thing I was looking at the time. This was GMO's 7-year asset class forecasts. They produce asset class forecasts based on reversion of profit margins to the mean and reversion of valuations to the mean. So you can see that at the time, US equities, international equities, all forecast to have negative real returns, with the only positive returns coming from emerging markets, at least within the GMO framework. Other things like the CAPE indicators were also suggesting similar sorts of things. So I did invest in a few asset-backed lending opportunities, but this was the horror story, SQN Secured Lending. So they had an IPO in 2014. They apparently were an experienced US manager, experienced in asset-backed lending, at least according to their own prospectus that I overly naively took too much credence from. There was a prospective 8% yield when they were fully invested. It seemed like there would be a spread of risks. And in fact, the initial experience was very good. Regular dividends monthly, in fact, not even quarterly. And in the search for yield that everyone was undergoing at the time, it was trading actually at a bit of a premium to NAV. However, a few years after they had initiated their loans, some of the reality came home to strike. And in the end, I came to the conclusion that they were really taking private equity style risk for bond-like returns. The sort of things they were backing weren't really what I would have called asset-backed lending. This wasn't lending to, typically say a property. This was lending to high growth and innovative areas. So hence why I called it sort of private equity style investment. The first one that went wrong was a loan to Suniva, which was a US company, but backed by a Chinese manufacturer of solar panels. And they got eviscerated in the price war that was affecting solar panels at the time. The other big area of mistake was their loans to anaerobic digestion plants. Now I thought, goodness, we've all heard of anaerobic digestion. Surely this is reasonably well understood, and if one is in a senior position, how wrong can it go? But it can go wrong. So these things, I think, perhaps 4 out of the 7 or 8 loans that they made were heavily written down. The initial manager, SQN, was eventually replaced after a couple of these profit warnings. And a third-party review of the assets led to massive write-downs. You can see the effect of that here in the total performance of the fund. A lot of what I invest in has got an income element to it. So I've been quite keen to find a charting provider who looks at total returns and not just at share prices. And if we look at the chart here, we can see the green line, the putative NAV, compounding up in a very straight line return that you'd initially hope for. The blue line is the share price return. And you can begin to see in 2019 the share price weakening when the stated NAV was still doing quite nicely. And the market had got wind of the troubles that the fund and the manager were having. Now, the first of the owning up exercises happened, the back end of 2019, beginning of 2020, and you see an initial big write-down. The share price didn't think that was an accurate reflection of the true horror, and the share price fell a lot more than the stated NAV. And this is one of the issues. I thought, how wrong can these NAVs really be? I mean, there's such a massive gap between the NAV and the share price that I thought, goodness, that the market has overreacted. Best to sit this one out. But in fact, the market had much more accurately appreciated what the risks and the outlook really were. And eventually, there was another mark-to-market of not mark-to-market, but a more accurate NAV assessment in the mid-2020. and you can see another massive markdown there. So what did I do wrong? Well, I was reaching for yield, wasn't I? I loved that 8%. I loved the monthly income. But I really think the ultimate error was this motivated reasoning. I had this asset allocation framework in my mind. I believed that I was trying to avoid equity risk and have a more secure position. And I was using my brain to justify holding on to something, which, when the reality had begun to change. I wasn't doing my homework, was I? I should have looked much more closely at the loans. So what I've tried to do with a couple of the other asset-backed lenders that I bought into is focus much more closely on the bottom up and not just accept a top-down view that this was an asset-backed lender. It fitted into my portfolio in a certain role. Debt risk. Very difficult to make it back up. With say an index fund of equities, you always sort of live to fight another day. But with this, when it's gone, it really is gone. The fall in the share price ahead of the fall in the NAV really was a lead indicator that I should have been doing better bottom-up analysis of what the risks were. And finally, diversification. Yes, I wanted to have this non-equity position, but that didn't mean that the individual bottom-up representation of that idea was necessarily a good reason or a good representation of that idea. So one of the things I've been impressed with you, Richard and Keith, is your willingness to sort of sell the loser, to admit error, to take the loss, and to move on. And that's something which I conspicuously failed to do here.
Great.
Great. Thank you very much, Stuart.
Thank you very much, Stuart. Yes, very interesting. A simple question to begin with is, what is a GMO, please?
Oh, sorry, GMO, that's GMO Woolly. That's an investment management company. It's Jeremy Grantham's place. He gets quite a bit of publicity.
Okay.
So over time, I've just sort of been following their observations about market levels.
Right, I see. So to give us a sort of scale of how much this meant to you, are you able to give us a very rough indication of what percentage of your portfolio this holding represented?
It was about 1%, at least initially. Obviously became about 0.25% after that performance. Yeah. It was part of a basket. I was trying to get a few secured, or hopefully secured, asset lending opportunities. There were a couple of others who worked out a bit better than this one.
Okay. So I was wondering, I mean, sort of reducto ad absurdum, you would do due diligence on every loan that the manager had before you entered into the purchase, wouldn't you? Where do you think, in the light of this experience, the balance lies?
Yeah, I think trying to think through individual, say the top few positions and clusters of position, and think what underlying risk have I got here? So the other funds that I invested in were much more property related. So you could make an estimate. You could say, okay, they're involved in hotels. So during COVID, there's going to be worry. Do you think it's going to make it through? But there's more of a sense of what the risk is. Whereas if it's solar panels, that's a big growth industry. That's a different sort of bet. It hasn't really got the same sort of asset backing.
Yeah.
So I think each time they produce their annual and interims, I should have gone through and more clearly thought about the underlying risks on that cluster of loans, that type of loan.
Sure. Yeah.
Well, thank you very much for coming on, Stuart. And in particular, I really wanted to get you on because you do things like the secured lending, which I know absolutely nothing about. So it's very interesting, having you on to discuss it. And I was very taken by your comments about how when a debt fund goes wrong, there's no coming back. And I had a few questions, actually. So if we just go back to the price chart, I was struck by several things. First of all, share price is drifting off. And given your comments about how, debt, if it goes wrong, it's a one-way street, and they're exposed to solar. I mean, it was very well known that Chinese cheap solar panels were undermining the economics. And I wonder, as it drifted off here, whether, if you'd had a look, you could have got out. But also what really struck me was how this green line seems to fall, 2 weeks before the blue line does. Is that actually accurate?
I think there might be a reason. I think it might be NAVs being reported with a lag. And so you're getting, say, that green line falling because 6 weeks after that the date for which the NAV is the calculation, is it published?
I see.
Yes,
see what I mean?
You're right, Stuart, because that is the 31st December. It's falling on 31st December. So it's been published later, but they've put that date on the 31st December. Okay, great, thank you. The other thing I'd say is, when you talk about bad news coming out, there's an old saying that there's never one cockroach. And one of the things I have learned slowly over the years is that, when there's bad news, it's not a great buying opportunity, which is what I used to think. And now I think there's not just one cockroach, that more bad news is probably in the price coming from the company. And I'd say that is particularly true when you have something like a private equity company where it's just so opaque and they are trying to always talk up the NAV. And the moment they have to admit something's wrong, you're in trouble.
I've heard that as well, and it's become my experience. And I think one of my errors was to over-believe an NAV. I thought, well, it can't be that far wrong. And if the thing is trading at 20% discount to NAV, am I the idiot who's getting out, at such poor value? But actually, it's better to take the loss at that level and move on.
So, Stuart, if you look at this chart, the share price chart now, the NAV looks like it's at a 50%. The price looks like it's at a 50% discount to the NAV. Is that true? And does that actually make it a good investment now?
Well, they're in the process of winding up, and there's, I think, the average duration or average maturity, of the loans is about 6 or 7 years. So the fear is that they're going to have to sell at a big discount to get the winding up done within, sort of 12 months or so. So probably it might be a good investment for someone who knew the details of each individual loan and was able to buy that and hold it to maturity. But I wouldn't say now's the time to bottom fish.
Stuart, can you just talk us through your general experience of secured lending vehicles and also how you find them?
Right, my experience with other secured lending has been much better. I'm invested in 2 others, GCP asset-backed lending and Starwood have got a European property lending fund. Both of those have been pretty decent because I think you're clearer about the collateral, you're clearer about the risks. The third one I've invested in is a more speculative one, but I knew it was speculative, which was lending to mid and small energy companies in the States who can't get access to capital markets and where banks don't want to lend to that area. So those have actually been pretty decent. I find them by scouring some of the chat boards and using CityWire, which is a reasonably, a very accessible, friendly, not too detailed service which reviews a lot of investment trusts. And from there, I get a name which sounds interesting, and then I try to go and do my homework and a bit better than I used to.
So, and how do you actually trade these?
Well, they're investment trusts. You can buy, sell them on the exchange, no problem.
Yeah.
Right.
Stuart, you mentioned that you used a specialist chart provider who gave total return graphs. Who is that?
That's Morningstar.
Right.
The charts, I've only just found them recently because I was looking for something which did include the income, because one of the other conclusions I had from that 2014-15 decision to try to focus a portion of my portfolio away from equities was to look for what you could call liquid alternatives. So this also included things like infrastructure funds and renewable energy funds, all of which have sort of between 4 and 6% income. So it's important to factor that in. You look at some of the share price charts and you think, not so hot.
Yeah.
But add back in the income and compounding that up, it's a more respectable return.
Yeah. Yeah.
Okay, well, thank you very much to Stuart for coming on and sharing his experiences with SQL Secured Lending. If anyone else out there would like to come on and share their experiences for the education of us and our viewers, you'd be very welcome. In the meantime, thank you once again, Stuart, and thank you all for watching. And it's goodbye from us all. Oh, press like and subscribe.
Goodbye, everybody, and thank you very much, Stuart.
Thanks very much for having me on. Bye, everybody.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.